You are now tuned in to the PPC podcast. Subscribe now for more exclusive content.
And today, we're literally just going to have an easy conversation about the UK economy, how things are looking at the moment, how it's affecting property, but more specifically when it comes to mortgages, because this is what Matt specializes in.
Yep.
So thank you for being in the room today. So before we even get into all of that, I want to start nice and simple,
Yep.
and just go with your background so people get an idea of who you are. I know you've been in mortgages for a very long time, in
Yep.
finance for a very long time. I think I saw 13 years on your...
A bit more than that.
Is that
I'm
more than
old.
that? Don't look it though. Don't look it. So yeah, you've got a lot of knowledge, and a wealth of experience. So yeah, if you want to give us a sort of a statement on your background,
Yeah.
how you got into sort of the position that you're in now.
Yeah, no troubles. So back in 2001, decided to leave the Royal Navy. Lobbing torpedoes out of submarines wasn't really transferable into the real world, but I was good with numbers, and I ended up getting a job in a bank, and that I was just doing loans and bits there. And then I heard about this company that was doing mortgages, and as I was now in the financial institution, I went and did that at a brokerage for a few years for another company. And then in 2005, decided was doing well enough out of that to start running my own brokerage. Did that until the fated 2008 when we had the credit crunch. I still carried on doing mortgages, but started working with local Portsmouth estate agents to just try and diversify because mortgages were getting quite tough back then.
Yeah.
Got more and more involved in property through doing that. And started working more regionally across the southeast for various different agents, but still moving a bit away from broking. But back in 2018, I decided I really want to get my teeth back into mortgage broking again. And I opened up RBM Solutions, which is essentially my kids' initials, Reese and Blake. And we've been going strength to strength from there. So all in all, I've been in mortgages now for over 20 years.
Wow.
So yeah.
Yeah, that's actually the first time I've heard you say that. Obviously, we've done a few bits together and known each other a little bit now. So, yeah, 20 years.
Yeah. That's why I'm great.
Nah, that's really good. So this is what I'm saying. Someone of your experience is great to speak to, especially in this day and age with everything that's going on. So I just want to quickly go back to 2008.
Yeah.
So leading up to that, there was a lot of risky borrowing, lending, which eventually caused the bubble to burst.
100%.
So in hindsight, are there any experiences that you had around then that stand out during that recession time?
I think whenever there's a recession, and we've seen it in the past or historically, normally you know it's coming. You can see it. But I think because of the risky nature of the way that lenders were operating, we had 125% mortgages. We had self-certification mortgages. Basically, there were lenders out there that were saying, just tell us what you earn. And they weren't actually backing it up or checking it out. And I know that there are some firms out there that would say, oh, you're a cleaner. So that means you run your own cleaning firm, does it? You must be on 50 grand a year. Self-certification mortgages. When you think about it as a risk profile, that's nuts.
Yeah.
But because there were so many mortgages being sold, what they were doing is they were saying, all these banks and building societies were saying, look, we're selling loads of mortgages. So all of these people would invest in them and think, oh, wow, look at these guys. They look amazing. So because it was artificially good, but there was no risk being taken because it was assuming house prices would always go up and everything else. And it just got to a point where it got so big. And then, especially in America, which always ends up translating over here, the bubble burst.
Yeah, big time.
You know, because people were refinancing, not really caring about fees because it's being put on top of the mortgage. And then all of a sudden it hit a point where these debts are going bad and they're going bad fast. And then all of a sudden it's shut down. So then rather than there being a peak and then a drop, it ended up being peak, slammed shut. And then it was literally like,
crazy.
Mortgage companies going out of business, banks closing the doors, and obviously the big bailouts that we ended up having to come from the government to keep the banking economy going. So there was 1,000,001 lessons that could be taken from what happened in the credit crunch. And obviously it can be a pain in the bum because of the regulation, and it does put a lot of things around what we can do, but it is sensible. It does make more sense.
Yeah.
You want banks to be lending responsibly.
Of course, yeah.
So the individual can sometimes see that as restrictive. Especially the common argument is, well, I pay that much in rent, why can't I pay that as a mortgage? I can deal with that later if you want. But it's more about they got to show they're being responsible, because they don't want to cause the knock-on effect is if they are irresponsible when they're lending, it will have a knock-on effect for the wider economy, just as it did in 2008. So it's where would you want to start with? What lessons can you learn from 2008? But in a nutshell, the three key areas that they're a lot tighter on now are the affordability. Can you prove it? And you got to think of it in terms of, I try to keep it nice and simple in all terms. So if I didn't know you and the bank doesn't know you, and you said to me, Matt, I want to borrow £300,000 and I didn't have a clue who you were, I'm going to say, right, okay, can you afford to pay it? Can you prove it to me that I can see that you've got the money to pay it? And if I'm looking at it thinking, well, I still know you've got to pay your car, you've got your gas, your electric and everything else you've got to pay, I'm going to work that out. Go, do I think this guy's going to be able to afford to pay it back? I'm also going to look at your risk profile, which is why the credit search is important. I'm not worried about credit scores. A lot of people get obsessed with what their score is. It's more about what is the detail within your credit portfolio. So if you borrow stuff, can I prove that you pay it back?
Okay, yeah.
And also, how much borrowing do you have? Are you living off of credit all the time? So are you actually affording it? So if I see, for argument's sake, you said, Matt, I want to borrow 300 grand. And I looked at your credit profile and I could see, well, you've got 4 credit cards and they're all maxed out. You pay them all, but they're all maxed out. I'm thinking, am I pushing him too far by giving him this extra money?
Of course, yeah.
Because I can see that he's racked it up, but he's paying a minimum all the time. Does that mean that he's at the edge of his afford? Even though you might look like you can afford it, I might be thinking from a risk profile, can he afford it? Or is he just keeping on borrowing? And then the third, so you've got, that's the affordability, that's the credit criteria, are you paying it back? And then the third one is, well, what's the security like? So if you said to me, what do you want 300 grand for? And you said, well, I want to buy a house for 500 grand. I'm putting 200 grand of my own money in. I'm going to be thinking, okay, well, if I lend it and he doesn't pay it back, even if the house prices drop, even if he doesn't look after it, the likelihood is I'm going to get my money back. I can at least do that. And is the house, is it made of bricks or is it made of twigs and berries? If it's made of twigs and berries, I'm not going to want to borrow it. Or if it's a caravan, you can take it away. I need to know that that's there. It's a real thing. It's tangible. And if it went bad, I can sell it. It's in good condition. If you said to me that, Matt, I want to borrow 300 grand and the house is worth 250, I'll think, well, even if you don't pay it, I'm never going to get my money back. So that's why deposits are needed. And when you combine all three of those, it circles back to, well, if I can pay £1,000 on rent, why can't I pay £1,000 a month on mortgage? Well, the very simple answer to that is no asset. So if you don't pay rent, they go, okay, off you go, out you get, and you can be out within a few months. If you don't pay the mortgage, you're sitting in their big asset. They've lent you hundreds of thousands of pounds, and that's why they need to be more risky. And that's the very simple answers to that one.
Okay, so that you're saying all of this, and obviously, I think in 2008 I was 16, 17. So I'll be honest, I had no clue what was going on. All I knew is everything was shutting down. I'm getting a part-time job. I'm getting paid. So I didn't really think of anything then. Now I'm an adult and I'm looking at it. So back then, those 3 bits of criteria that you've just described. So am I right to assume that not everyone was thinking like that? Like they weren't looking to get those bits of information before they give out mortgages?
Well,
was it a free-for-all before that? Like,
if we take the first one, security. So if you had a really bad credit profile and you weren't able to prove your income, they'd still lend you around 95% of that property's value. So I could turn around. So self-cert mortgages was what they used to be called, where you would just make a declaration and sign. No pay slips, no bank statements. You're making a signature to say, I earn that much. And then all the lender would do is a plausibility check. Is it plausible somebody could be earning that? And they go, okay, fair enough, that's plausible. And they would sign it off. So they're one of their 3 core areas of risk is being ignored, because because there's so much competition for mortgages that That's how so many people got on the housing ladder so quick. Northern Rock famously doing their 125% mortgages. Now, what they actually did was 95% on a mortgage and then 30% as an unsecured loan over the same terms and rates as the mortgage. But and no matter how well you slice it, they were lending 125% up to that. So you were borrowing more than what the asset was worth.
Yeah.
And as far as your credit was concerned, nowadays, if you've got adverse credit, you're very lucky to get through with a 10% deposit. 15% typically lenders start lending, because what they want is they want some skin in the game, hence your deposit, in case it goes bad. And it depends on the level of adverse. Now, you can have people, I remember from the criteria, they would turn around and say, if you've had 2 or 3 missed payments in the last 12 months on your mortgage, which is quite big from lender's point of view, they would still lend you around up to 90%. Nowadays, pretty much all lenders need you to be clean on your mortgage payments for the last 12 months. Because while some of them can be flexible and they can turn around and say, look, we understand people have problems, things happen. If it's historic, more so mostly after over 3 years, but anything small within the last 3 years, they go, right, is there a reason for that? Or is it just because I just didn't pay attention? Then they're going to not be happy with that. But if you say, look, there was a bereavement, I lost my job, found another job, it's a life event, makes much more reason. But back then, they didn't care. They goes, did you miss that money? Yep, well, it fits on this scorecard, that's your rate, that's your payment. And people were going, great. So they weren't. Wow. This is why so many debts went bad. And that's what caused, in a nutshell, the collapse of the economy.